Hey there, fellow investors. Welcome to another exciting journey into the world of finance. Ever wonder why stock prices jump around like a kangaroo on a trampoline? It's not just random chaos. Sure, financial reports and earnings calls matter. They provide the backbone of our analysis. But there's a secret force at play, a hidden current that can make or break your portfolio. Market sentiment. It's the heartbeat of the market. Think of it like this. The stock market is like a giant auction house. Every bid and ask is a reflection of someone's belief and emotion. Buyers and sellers clash, driven by their emotions and perceptions as much as cold, hard facts. It's a dynamic dance of psychology and numbers. This collective feeling, this mood of the market, is what we call market sentiment. It's the invisible hand guiding the market's movements. Ignore it at your peril. Market sentiment can turn the tide in an instant. Understanding this elusive force can be the difference between riding a bull market to riches or getting trampled by a stampede of bears. It's the key to unlocking market mysteries. So buckle up and let's dive into the fascinating world of market sentiment. Together, we'll uncover the secrets that drive the market's mood and learn how to harness this power for smarter investing. Feeling the pulse of the market. It's like trying to gauge the mood of a crowd at a concert or a sports event. Let's cut to the chase. Market sentiment is the heartbeat of the financial world. Market sentiment is simply the overall attitude of investors towards a particular stock, sector, or the entire market. It's the collective mood that can drive prices up or down. It's the collective gut feeling about where prices are headed, whether up, down, or sideways. This sentiment can be influenced by news, economic indicators, and even social media trends. Imagine a room full of investors. Each one has their own opinion, but together they create a powerful force. Are they buzzing with optimism, ready to buy any dip? This kind of positive sentiment can drive prices higher and create a bullish market. Or are they whispering nervously, fearing a crash is imminent? Negative sentiment can lead to a bearish market where prices fall and fear takes over. That, my friends, is market sentiment in action. It's not always rational. Remember the dot-com bubble? Investors were driven by the fear of missing out. Pure euphoria drove prices sky high, even for companies with no profits. This irrational exuberance can lead to bubbles. Conversely, fear can be just as contagious, leading to panic selling and market crashes. When sentiment turns negative, it can create a downward spiral that's hard to stop. In the wild world of finance, two powerful creatures reign supreme: the bull and the bear. A bull market is characterized by optimism and rising prices. Investors are confident, buying up stocks and pushing the market higher. Think of a bull charging ahead, horns raised high. On the flip side, a bear market is a time of pessimism and falling prices. Investors are fearful, selling their holdings and driving the market down. Like a bear hibernating, the market retreats, waiting for brighter days. Understanding these cycles is crucial. By identifying whether the bulls or bears are in control, you can tailor your investment strategy accordingly. What influences market sentiment? A whole lot of things. Economic data, company earnings, geopolitical events, even the weather can sway investor sentiment. Think about it. A positive jobs report might spark a rally, while rising inflation could trigger a sell-off. A surprise interest rate hike by the Federal Reserve? Get ready for some market turbulence. News headlines can send shockwaves through the market, especially in our hyper-connected world. Social media amplifies these effects, spreading fear and greed like wildfire. Remember the GameStop saga? That was social media-fueled sentiment in its purest form. Section 5. Case studies decoding sentiment in real-time action. Let's bring this home with some real-world examples. Remember when Reliance Industries announced its foray into green energy? The stock soared on the news, fueled by investor excitement about the company's future prospects. That's bullish sentiment at play. On the flip side, Consider Infosys. When the IT giant issued a weaker than expected earnings forecast, investors panicked, sending the stock tumbling. Fear and uncertainty gripped the market, a classic example of bearish sentiment. These examples highlight the power of sentiment. Even for blue-chip companies like HDFC Bank and Tata Motors, news flow and market perception can significantly impact stock prices. Section 6. Technical Analysis. Charts. Don't lie, they whisper sentiment. Now, how do we measure this elusive beast called market sentiment? Enter technical analysis, the art of reading charts and deciphering market psychology. Technical indicators like the Relative Strength Index or RSI and moving averages provide valuable insights into investor sentiment. A high RSI suggests overbought conditions and potential price corrections, indicating exuberance. Conversely, a low RSI might signal oversold conditions and buying opportunities, reflecting fear or pessimism. Moving averages, on the other hand, help identify trends and potential trend reversals. A break above a key moving average can signal bullish momentum, while a break below might indicate bearish pressure. Section 7. Fundamentals matter. The long game of sentiment. While technical analysis provides a snapshot of short-term sentiment, fundamental analysis helps us understand the long-term picture. By examining a company's financial health, its management team, its competitive landscape, and its industry outlook, we can gauge the underlying sentiment towards its long-term prospects. Strong fundamentals, like consistent earnings growth, a solid balance sheet, and a competitive moat, tend to attract investors and foster bullish sentiment. Conversely, weak fundamentals can lead to bearish sentiment and declining stock prices. Section 8. Profiting from sentiment, tips and tricks for savvy investors. In this chapter, we will delve into the nuances of market sentiment and how you can leverage it to maximize your investment returns. So, how can you use market sentiment to your advantage? Market sentiment reflects the overall attitude of investors towards a particular security or financial market. Understanding this can give you an edge. Here are a few actionable tips. Number 1. Stay informed. Staying informed means more than just reading headlines. Dive deep into financial news, understand the context, and keep an eye on global events that might impact the market. Keep your finger on the pulse of the market. This involves regularly checking updates, subscribing to financial newsletters, and following credible analysts on social media. Follow news, track economic data, and pay attention to analyst ratings. These elements can provide insights into market trends and potential shifts in sentiment. Number 2. Use technical analysis. Technical analysis involves studying past market data, primarily price and volume, to forecast future price movements. Learn the basics of technical indicators to gauge short-term sentiment and identify potential trading opportunities. Indicators like moving averages, RSI, and MACD can be particularly useful. Number 3. Embrace fundamental analysis. This involves evaluating a company's financial health, including its revenue, earnings, future growth potential, and overall economic conditions. Understand the long-term story behind a company's stock price. Look at the company's business model, competitive landscape, and management team. Look for strong fundamentals and sustainable competitive advantages. Number 4. Don't panic. Market volatility is inevitable, but your reaction to it can make all the difference. Avoid making impulsive decisions based on short-term market swings. Emotional decisions can lead to significant losses. Remember, sentiment can change quickly. What seems like a crisis today might be an opportunity tomorrow. And number 5, be patient. Patience is a virtue in investing. It allows you to weather the storms and benefit from long-term growth. Investing is a marathon, not a sprint. The best returns often come to those who wait and stay the course. Let your investments grow over time and don't be afraid to ride out short-term volatility. Trust in your research and stay committed to your strategy. Section 9. The contrarian approach, zig. When others zag, remember, the crowd isn't always right. Sometimes, the biggest profits are made by going against the grain. This is the essence of contrarian investing. When everyone is bullish, ask yourself, is the market getting ahead of itself? Are prices justified? Conversely, when fear grips the market, look for undervalued opportunities that others might be overlooking. Remember Warren Buffett's famous advice: be fearful when others are greedy, and greedy when others are fearful.